when David Einhorn sat down at his lunch table with a handful of other people with Ben Bernanke, he had a couple questions on his mind. And one of the questions he asked Ben Bernanke was, how sure are you that what you're doing is going to work? And Ben Bernanke said, well, I'm 100%. I'm 100% sure of what the Fed is doing is going to work. Now, David Einhorn, if you don't know, is a hedge fund manager. He's actually a very successful hedge fund manager. He himself is a billionaire, and he manages billions of dollars of other people's money. And he also has a reinsurance company. So this guy's pretty good at what he does, David Einhorn. And so when he heard Ben Bernanke say, well, I'm 100% sure that we will not get hyperinflation and we can manage inflation, and there's no doubt that we'll know exactly how to handle this. What scared David Einhorn is he said, I'm not 100% about anything, sure about anything. I don't even know if it's a Wednesday today. Like, maybe if he would have said, if Ben Bernanke would have said, I'm 99% sure, then David Einhorn's question would be like, well, how do you manage that 1% that you're unsure about? Like, how do you manage that risk? But Ben Bernanke was 100% sure that what the Fed is doing is going to work, which if that doesn't scare you, I don't know what should when it comes to economics. So the theme for you this weekend, for us this weekend, is this idea that people will act rationally. And I bring this up as the theme because this is a foundation. This is a presupposition of economists when looking at the markets. Economists' first assumption is that people will act rationally. Now, if you're not already laughing out loud that this is the main pillar or foundation that economists use when looking at the stock market, you can start now. But this is the foundation of economists when looking at the stock market. They believe that people will act rationally. And sure, maybe there will be some people who do, but as a group, I am 100% sure that humans will not act rationally as a group with their money in the market. So the theme is how do we leverage this idea that in fact people will not act rationally? And that comes back to a theme that you've been hearing me talk about again, is that there is an incredible inefficiency in the stock market. And academic economists and conventional advisors and big box advisors will want you to believe that the market is very efficient and you can't beat an efficient market. In fact, you just need to listen to the market. But I take the exact opposite view that, in fact, the market is incredibly inefficient. And I want to give you one real-world example that's happening right now. So there's this company called eBay, and it's been around for a while. In fact, it's been around so long that it has built such a wide moat around it. It's a wide and deep moat to the point that no one can really challenge eBay in its own space. And as of today, there's about 750,000 people, 750,000 people who get their full-time income or some portion of their income consistently from eBay. So this is a very successful company. Now, if you look at the price chart here, this is a price chart. It starts in 2010, but the main thing I want you to look at is 2011, starting right about here. And you can see that it just kind of went sideways in 2011. It kind of bounced between about $27 and $33. Didn't do much. Well, if you remember in 2007, here in September, the stock market absolutely imploded. It fell about 20%. But eBay didn't. eBay kind of did its own thing. This really shouldn't happen. eBay should have participated in that 20% correction. It was actually about a 22% intraday correction in the stock market, but eBay didn't. eBay just kind of went sideways, right? So here's an outlier of a company that is really doing its own thing. And it was consolidating here. And when stocks consolidate, that gets people very anxious. They don't want to be in stocks that consolidate, that kind of go sideways. They only want to be in stocks that go straight up. So eBay was very out of favor in 2011 and kind of was doing its own thing, okay? Not really acting its part. Well, in 2012, it broke out of this sideways channel between $27 and $33, which was about a 10 to 12% price range, which actually is not that wide of a price range. And it broke out. And in 2012, it went up almost 100%. It almost went from $30 to $60. And depending on where you start, it would have gone up 100%. But as of the measurement of this price chart, in 2012 to the very beginning of 2013, it went up 87%. Well, in 2012, the stock market in the U.S. only went up 10%. And if you see this line up here, this horizontal line, that's its lifetime high. That's the price eBay hit way back in 2000. This should never happen. You should never have a stock that goes up 800% more than the stock market. And this is not a little teeny startup. This should never happen. You should never have a company like eBay go up 87% when the overall stock market goes up 12%. That should never happen. But this happens all the time. This is the inefficiency of the market. This is the irrational behavior of humans. And then it hit this. eBay's price hit this lifetime high that had started back in 2000. And in 2013, now this is 2013, just last year, look at how visually volatile eBay was. It was bouncing really between about $57 down to about $49. That's about $8. About a 15% movement, just bouncing up, down, and just look how volatile it is, bouncing up, bouncing down, bouncing up, bouncing down, bouncing up, bouncing down, way up in 4 weeks, and then it just cratered below. So literally for about 14 months, eBay was just annoying people during the exact same time period where the stock market went up about 35%. Pretty amazing, isn't it? Well, the last time eBay went sideways and did nothing and annoyed people and consolidated, kind of coiled, that coil is about to spring, it went up almost 100%. And so here we are, upper right corner of this price chart, right about $57. Now, I want to zoom out and just show you that whole range. So here's back in 2011 right here, where eBay just kind of went sideways, very inefficiently, annoying people, probably angering people. And then it took off into the upside about 100%, depending on where you start and end your line. And then it's just been consolidating. And it's been consolidating while the stock market went up about 35%. Again, this should really never happen from a large company. This is not a teeny company. This is a $60 to $70 billion market cap company with a huge moat. You'd think this would participate. But look what happened here in 2014. It broke out to new lifetime highs. So I'm sure people jumped in and then absolutely did a 20% correction. 20% correction. That is a huge correction. eBay lost about $12 billion in its market cap. $12 billion in its market cap. That is incredibly inefficient, and people are being very irrational right now. This is the same thing we saw with Intel when it fell 33%, and when Apple fell 43%, or when Disney fell 35%, or when McDonald's fell 20%. This inefficiency is happening all over the place. And here's an example where eBay fell 20% when the market didn't, when the stock market didn't, and it has coiled. And I believe what we have is another example of eBay about to go up 100%. And it bottomed right here, and it is so out of favor, and all news follows price. So you know the news has been bad all through 2013 and halfway through 2014. It has all been bad for eBay, just like it was all bad news all the time for eBay in 2011. And then guess what happened in 2012? All the news was good. Price tells you the story. There are inefficiencies all over the place, and these inefficiencies are what can help you get a secure future with more choices. Inefficiency is all around us, and the market is not efficient like academic economists want you to believe. They believe in their academic papers, but they don't live in the real world. Now, the main takeaway is that people's irrational behavior is actually predictable. Maybe not one individual person's behavior, but when you group them together, it is very predictable and very profitable. And it happens over and over and over again. And when I've studied this back decades and decades and decades, every year there are dozens and dozens of these inefficient examples of individual stocks or sectors falling way too far. It's because of how people are being very irrational in how they behave with their investments. And that will never change. This is what we do in Fearless Wealth, in the membership. This is what I teach people to show them how they can actually implement this in their own lives. It's one thing to have the content. There's lots of content out there. A lot of it is free. Content actually isn't worth that much. It's actually implementing the content. And that's something that actually very few people do in this world. And that's why when my clients come out of my coaching, they actually behave differently, because they shift the way they're behaving in the market. Literally everything pivots off how people behave. So if you want to shift or have a different experience in the stock market, you want to first look at how you have been behaving. This is just another step in helping you secure your future with more choices. Until next time, I'm R.C. Peck.